We'd like to welcome our viewers. My name is Eric Fox, Chief Economist at Veros Real Estate Solutions.
And I'm Reena Agrawal, Research Economist at Veros Real Estate Solutions.
So, Reena, today the big news that's been recently reported is that the Consumer Price Index has actually gone up from 3.2% in February to 3.5% for the month of March. And of course, we're always interested in what does that mean for the future of housing prices. So right off the bat, it doesn't look like the Fed is going to have the data and the ammunition it needs to cut rates. And so the question is, how is this going to impact the housing market and the future of house prices?
So I think we're going to see more of the same, or in fact, a little bit of an uptick in house prices. Our recent forecast, which we had out in March, shows that house prices are forecast to increase by around 2.9% on average across the country. And why we are seeing still a price increase rather than a decrease in prices is because mortgage rates are going to remain elevated and the supply still remains really low in the market. So those few people who are willing to sell their properties are again encountering a lot of buyers if their house is in a good shape. So many buyers chasing few properties, so prices will keep on increasing, though not at a major rate. And this is what we forecast last quarter in December as well. Then we forecast a 2.4% increase in prices. So we're just seeing the market continuing to remain in that same place with low supply, unaffordable housing for many, and those who are not locked into mortgage rates are free to sell and buy. They are not impacted by the high rates. And they are the ones, even if they do have to shell out some money for mortgage rates, it's okay for them to get that mortgage at this current 7% rate. So that's where we are forecasting the house prices to be.
So really no let up in the forward acceleration of prices. So now the rate you gave for the average forecast of 2.9% is kind of overall different markets. Do we see some markets in the US or parts of the country where we see things being even stronger than that with even stronger appreciation forecast?
Yeah, we're seeing markets that are traditionally being affordable, these small towns in the Northeast and the Midwest, where the median house price is still kind of lower than the average median price across the country. There we are seeing that they are attracting a lot of first-time buyers because not only are they offering homes at a relatively low price, but they're offering that lifestyle that many want. So those places are experiencing higher rates of appreciation, more in the 6 to 7% range. But we are seeing a slowdown in some Sunbelt regions like Florida and Texas. Florida, because insurance rates are going through the roof. And Texas increased a lot recently, so buyers are kind of hesitant to go in there. For example, in Austin, Texas, where we are still seeing some depreciation, and we are seeing recovery in some markets in the West, like in Arizona and California, that were earlier depreciating, but now they are recovering from those depreciations. So yes, house price changes are varied across the country, and 2.9% is just an average overall.
Well, that's very interesting, and it still points to the resiliency of this housing market. Can't be derailed easily by continued high mortgage interest rates.
That's correct, and also because mortgage rates are high, new construction has been slowed down because of rising labor costs and material costs. So supply is limited from that point as well. So low supply and continued robust demand is going to keep prices going up.
Sounds like economics 101 to me.
That's right.
My name's Eric Fox. Thank you for joining us.
And I'm Reena Agrawal. See you next time.